How is the housing market holding up? Is the housing market still going to crash like everybody was projecting this year? It seems like values keep going up. The market just gets hotter and hotter. There's more competition for houses. Builders are selling as fast as they can get them built. And they're actually getting a little cautious, putting the brakes on some projects because costs are going up so fast. They want to make sure that they can capture that price escalation and not get caught holding the bag on a house that somebody can't qualify for when it's done. But we're still seeing multiple bids on houses. We're still seeing record low inventory, even though a lot of people are going to go ahead and are putting their houses on the market and going ahead and getting them sold because the prices just make so much sense right now. They're so inflated that people are like, if you're going to sell, now's the time, and they're renting, waiting for things to cool off. A lot of people are sitting on the sidelines and waiting for prices to come down, and some people are just flat getting priced out of the market that either can't afford the down payment or it just doesn't make any sense based on what they're paying in rent. So we're starting to reach a point where there is pushback. There are some properties that are sitting on the market in some areas, but for the most part, houses are still selling in days. We're still getting multiple offers and the market is still red hot. So where does that leave us with forbearance expiring, moratoriums on evictions expiring, things like that? Well, we are coming out of the pandemic. This is mid-May of 2021. We are coming out of the pandemic. Most of the population is getting vaccinated. Things are opening back up. So the supply chains are going to start opening back up. So therefore, builders will be able to start building a little bit faster once they can get materials to the job site. We can get more people in the labor pool. People start going back to work with the unemployment benefits expiring. A lot of states are getting rid of them now, not letting them run through the end of September. So people are going to be getting back to work. We're going to be getting open back up, and the supply chain is going to open up. So that means that we're going to be able to deliver houses a little bit faster than we have been. But the real question is, are people going to now start putting their houses on the market? And what could change things? So again, it always boils down to interest rates. Keep your eye on interest rates. The Fed is now recognizing that we are in hyperinflation. They're starting to say that they probably need to start thinking about tapering, which means cutting back on the bond purchase program, which will increase rates on bonds, which will increase interest rates, which is going to increase mortgage rates on houses. So keep an eye on what the Fed is doing and what they're saying. Keep an eye on interest rates. Keep an eye on the stock market. A lot of this stuff is baked into the stock market. We've seen a little bit of volatility there because of the threat of inflation and rising interest rates, because they know what that means. And that's the only thing right now that could cut this housing market slam in half, is if interest rates start rising and if they get back to where they were, which again, even if the rates doubled right now, those are fantastic interest rates historically considering where we were at one point in this country with double-digit interest rates, high double-digit interest rates for houses. At one point, interest rates are still sub 3% for the most part. They've gotten over 3% up and down, back and forth, but as long as we stay under 4%, we're okay. We start getting up to 4% and over 4%, that's the tipping point for a lot of people and for a lot of affordability index for people. So that was an ambulance there. It came out of nowhere. So that affordability index, people are buying payments, and when it makes more sense to buy than rent, that's when the millennials started jumping out there buying houses and taking advantage of these low interest rates. So just keep your eyes on the market, keep your eyes on interest rates, keep your eyes on the Fed. They are now talking about taper. They're talking about interest rate increases. I have a hunch that we're going to see some action by the Fed before the end of the year. At the very latest, first quarter of next year. That's going to push rates higher. That's going to create a sell-off in the stock market. And that's when you're going to see things change in the housing market. So does that mean there will be a crash? And what does a crash in the housing market really mean? When I say housing market crash, what we're talking about is just values. So the real question is, for people that have just bought a house, and if you're watching this and you just bought a house, and let's say all of a sudden, end of this year, next year, your house is worth 30% less than what you paid for it, what are you going to do? How do you feel about that? And what if it stays that way for a long time? What if the house is worth less 20, 30 years from now than you paid for it right now? How would you feel about that? Are you still good with it? So that's going to be the real question. When the values start falling, the real question is, how are the buyers that have paid all-time highs, record highs for these houses, if the values start falling and level off over the next 10, 20, 30 years, how are they really going to feel about it? And more importantly, what are they going to do about that? So that's the question. That's what's going to really end up resulting in what the effects of inflation, what the effects of interest rates are, and what the effects of the current economic environment, hyperinflation, competitive nature of the housing market are going to be. Then we'll know what the real effects are going to look like. We're going to know what people are going to do, what the banks are going to do, and what the ultimate result of all of this monetary easing, low interest rate environment is going to have on the economy and the housing market moving forward into 2022.